Hi, this has been a historic week for REIT investors because on Monday this week, the disgruntled shareholders of Sabana filed its motion to remove the REIT manager. The REIT manager's response on Tuesday, the 7th of Feb, actually presents very good, interesting points for the REIT investors. Let me go through some of them. One is that if you look at the performance of Sabana REIT, the managers attribute the huge fall in the DPU from 9.38 cents to 5.01 cents over the years from 2013 to 2015. That's a whopping 46% drop due to one. It says the expiry of master leases. It also says that the risk of non-renewal and terminations of master leases present potential adverse impact on gross revenue. It says that the ability to find replacement master leases or tenants depended on the market conditions, and the demand for the properties. Now, you and I know that industrial properties have been weak. So, did the other REITs of comparable sizes like Soybil, Ames, Viva suffered the same fate, as in a sharp 46% drop in the DPU? So if the answer is not, then how does one attribute this due to master leases and market conditions fall off? Interesting, right? Now, the key thing, of course, is that before the termination of master leases, the share price still was able to creep up a bit as of April last year. And as many of you would know by now, that's where I sold off my 3.01 million worth of Sabana shares. Now, how was I able to actually sell off, before the share price actually collapsed more than 50%? It's something that I will share, in my upcoming classes on the 11th of March, as well as on the 25th of March for the prestigious clients of financial institution Maybank KE. So do sign up at Eventbrite if you want to know more. We will go through the techniques of how one is able to decipher when does fundamental valuations actually start to deteriorate and when do the warning signs actually tell the REIT investors to sell off the conditions as what I did. Now, the second point that Sabana actually disputed the minority shareholders in terms of the arguments was the fact that the purchase of 47th Changi South from the sponsor at 23 million. That's presented a very interesting case study because according to the words of Sabana REIT manager, it says that the sponsor had purchased the property for its own use, and therefore the book value of Changi South property in the sponsor book reflected the original cost of acquisition of the property by the sponsor less accumulated depreciation. So essentially what Sabana is buying is the remaining net book value over 40 years from the sponsor. As such, it says the book value is irrelevant and not a good basis for comparison. Boy, in the last 1 week, I've been checking with my accounting friends. When does book value becomes irrelevant? This is interesting because I have never got a very good answer. So, but in my class on the 11th of March, as well as the 25th of March, I'll be discussing it. And going ahead, it says that the price was independently valued by Service and Knight Frank, the two valuers, which coincidentally came to the same valuation amount, 23 million. That takes into account the long-term lease of the property and the rental income support provided by the vendor before arriving at the valuation of 23 million. Now, what I find interesting, ladies and gentlemen, is the fact that Sabana did not dispute that the value of the property was at 9.9 million the previous year at the sponsor's book. Sabana is proposing to buy 23 million, that's 100% more, for a property that has a lifespan of 40 years. It justifies by saying that it's a long-term lease. if you read the black and white clearly, it says that the sponsor is going to rent at 74% of the space for 10 years, not the 40 years, yeah? Okay? Now, the other key point to note is that while the sponsor is actually incurring the master lease for 10 years, now, it is only 3 years where they have given you the guaranteed income of 2.1 million. Okay? Now, again, the announcement did not tell you clearly what are the key parameters where one is able to gauge whether indeed the rental that the sponsor is paying is actually above or below the market. Now, this is key, ladies and gentlemen, because if the master leases are actually contracted at higher than market average, then after the 3 years, what will happen? There will be a drop, right? Okay, so if that's the case, the income from master leases will drop, and therefore the property from the 47th Changi South Avenue. Now, therefore, does it not mean that that will impact valuation? Have the valuers taken this into account? I'm sure they are reputable firms and they would be able to justify that. But it will be interesting to see whether they will come out and actually justify this, because to many investors, I think the management have failed to explain that, hey, how do I justify buying a property 9.9 million at 23 million, where it is for long term 40 years, but in actual fact, the rental contract is for 10 years. Income support, rather, in this case by the sponsor, but in actual fact, the 2.1 million that the sponsor will pay, which translates to 1.91 per square foot for property around the area, it's only for 3 years. So it's interesting, I'm sure basically there are more points that's coming out. So do stay tuned. In the meantime, if you want to sign up for my class, look at that. Watch out on my article that's coming up on BT Online, Expert of the Month. That's my article talking about when and how were the deteriorating fundamentals that prompt me to sell off my 3.01 million shares before the share price took a 50% drop. So once again, this is Gabriel Yap, your REITs Guru, signing off. Have a good week ahead, and God bless you.